A new financial crisis on par with 2008's is being feared after the recent failures of Silicon Valley Bank, and Signature Bank. Following the 2008 failure of investment bank Lehman Brothers, global credit markets froze, triggering the worst economic downturn since the Great Depression.
From Credit Suisse to crisis. They say all press is positive, but Credit Suisse has had more than its share of bad headlines. Founded in 1856 by industrialist Alfred Escher, the Swiss bank grew to become one of the biggest financial services companies operating in around 50 countries across the world. It came out of the 2008 financial crisis in a relatively strong position and did not take any government bailouts. In the aftermath, the bank cut jobs as it pivoted away from risky investment banking to focus on wealth management. That brought problems and was soon pulled into a number of cases for assisting tax evasion.
We should have caught it. We should have had managers, we should have had control people who caught the fact that this was happening, but absolutely, they were wantonly violating our policies.
Its global presence brought risks. Raising $2 billion of funding for Mozambique's fishing industry saw Credit Suisse drawn into a wire fraud criminal probe. In March 2019, it emerged that Credit Suisse had hired private investigators to spy on a former employee it suspected of taking its clients.
Our shareholders have been extremely robust. If you look at the share price, it's not the share price of a company in crisis.
2 years later came more problems. The collapse of supply chain financing company Greensill Capital embroiled the bank. Swiss regulator FINMA said it made partly false and overly positive statements when it marketed $10 billion of funds to clients as a safe investment. But soon after came Archegos Capital Management. The collapse of Archegos brought Credit Suisse $5 billion of losses and saw executives fired. It's also found itself the first Swiss bank to receive a criminal conviction tied to a cocaine smuggler. Efforts to reassure investors ran into problems.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That saw FINMA open another investigation when the bank reported those outflows had continued. As the bad news came in, losses mounted and investors became even more wary, including its biggest, the Saudi National Bank.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory.
And those few words were enough to send Credit Suisse shares diving to an all-time low. Even a $54 billion lifeline from the Swiss National Bank could not erase all the losses. It may have lasted 167 years, but Credit Suisse will be remembered for this one.
Welcome back at Financial Fortune, your daily advisor that gives you news and tips for financial success. Just keep on watching. Keep in mind that SVB is not at all like Lehman Brothers. Because SVB's primary focus was on the technological aspects of the venture capital industries, the economic fallout from its demise is likely to be contained to that sector. Silvergate and Signature Bank have been concentrating on the cryptocurrency sector, which is only a small part of the overall economy. Thus, it is unlikely that the 3 recent vein collapses would cause a wider recession, even though they could have impacts within their respective industries. Credit Suisse, however, is an entirely different matter.
Compare Credit Suisse's situation to what we saw when it came to Silicon Valley Bank. How different are those two situations?
In many ways, Shauna, they're somewhat polar opposites. It's kind of weird. I mean, Silicon Valley Bank, they really got into trouble for being a plain vanilla bank. They had plenty of deposits. They got too many that they could deal with. So they then went out and bought what appeared to be safe assets, mostly government securities. The problem is they had what we call a duration mismatch. Your short-term deposits, which are liabilities to a bank, they can be called at any minute's notice. Your longer-term assets, which typically for a bank include things like company loans and mortgages and stuff like that, which they had too, those are not so easy to sell. And the problem is compounded when the yield curve inverts, because the money that you have to pay in interest on those short-term deposits starts to outpace the money that you're receiving on your longer-term assets. So when the bank when people started to want their money out of the bank, They then had to sell pretty much what they could, which was their treasury holdings. The problem is because rates had gone up, those holdings had gone down in price. Eventually, at some point, they'll be worth par. But in a mark-to-market situation, all bets are off, and they just their ability to repay their depositors, fell short, because they just couldn't sell enough assets. Credit Suisse is fundamentally different. It's globally systemic. They've got, they're in more or less every capital markets business in most of your major economies all over the world. They're really systemically important to Switzerland. When you think about it, there's really two big banks. It's UBS and Credit Suisse. And the difference there is they've had their management instability. They got involved in the Archegos debacle when they've really stepped in it a number of times, and I think that's largely because of their difficulties in keeping a steady helm. And so it's very different. One is real vanilla, the other one is much further out there. But let me stress that even Credit Suisse isn't as stretched necessarily as some of the worst offenders that we saw in the global financial crisis.
Well, and to that point, what is the solution for Credit Suisse right now? How does the bleeding stop in the rest of the banking industry?
That is the trillion-dollar question, Ines. I think basically at some point, one of the reasons we got this little bit of a bounce here in the afternoon was there's talk that the Swiss authorities are actually going to do something or look into this. I don't know why. I don't know why it took them this long. It's not like this was a secret, but clearly they have to do something on their end because it's really systemically important to the Swiss, but they can't do it on their own because of Credit Suisse's role in so many other places. So, to the extent that they can organize something that staunches the bleeding, I don't think we're going to see the stock back anywhere near its level that it was at its heydays anytime soon. But at some point, it sounds like they're trying to come up with something to put a real, to actually do some surgery rather than put a Band-Aid on the patient.
Well, Steve, when you look at the bond market right now with yields plunging, it looks like the bond market at least is signaling the risk or really the scenario of a hard landing. Is that something that you see as more likely at this point?
Yes. I didn't actually see it as unlikely before, which I guess maybe is part of the answer to your question. But right now, the bonds are basically part of what I would call this get me out trade, this return of capital. Because you will get your money, you're going for no credit risk in treasuries, and by going for short-term treasuries rather than longer-term treasuries, you have less market exposure, less sensitivity to interest rates. The problem that we have here is if you can't price short-term risk-free assets, how do you expect to price risky assets like stocks? Basically every valuation model is centered around the idea of a risk-free rate of return. On top of it, if you're getting volatility in the stuff that's not supposed to be volatile, how you can't expect to not see volatility in other parts of your holdings or in the market. So that's a lot of what we're wrestling with the disjointed nature that we're seeing in short-term fixed income. It really puts us on tough sledding, and I don't see us being able to really calm down until or unless we see bond rates, come to some sort of equilibrium. 5 days of 20 plus basis point moves on a 2-year note is nuts by historical standards. I have no other word to put it.
It certainly is.
And until we...
Yes, Steve, apologies for cutting you off there. It certainly is nuts. And then if we do get that hard landing scenario, which it sounds like you do believe is going to happen, how deep, though, is that recession going to be? Because I think that is what everyone is trying to figure out at this point.
I want to sort of separate it into two parts. I think financially, we're sort of seeing the process of the hard landing. Anything that revolved around liquidity, that rose on the way in has been suffering from the withdrawals on the way out. Withdrawals can be painful depending on, no matter what sort of situation you're talking about. Can we stay in good stead in terms of the broader economy? It's possible. And so I think we have to sort of separate the real world from the financial world to some extent, because we still see very strong JOLTS numbers, off their highs, but still there's many more available jobs than there are people to fill them, which means people have money to spend It also, right now, they're not particularly confident about spending it. But I do think that, we could see a fairly hard landing financially, and clearly we've seen it in a couple of banks already, while not necessarily being quite so dramatic on the real economy side.
The Swiss bank, with assets of over $500 billion and a presence in more than 50 countries, is a major international financial institution. The fallout from a failure at Credit Suisse would be much greater than at SVB by several orders of magnitude. Shares of Credit Suisse have lost nearly 90% of their value since the beginning of 2018, and the decline has accelerated in recent months. Credit Suisse chairman Alex Lehman recently made an appearance in the media on March 15, 2023, claiming that the bank's financial position was strong and that they had no plans to ask the government for aid. The bank announced the next day that it would be borrowing 50 billion Swiss francs from the Swiss central bank in an effort to improve its liquidity. Since 1 franc was worth $1.08 at the time this video was shot, the central bank loan amounts to $54 billion. We'll investigate Credit Suisse's predicament in detail to see if it portends a larger financial meltdown.
The Swiss bank Credit Suisse announced yesterday it will borrow nearly $54 billion from the Swiss central bank to shore up liquidity, and it will seek to repurchase debt. The troubled bank is hoping those moves boost investor confidence. Still, the bank shares plummeted by as much as 30% yesterday after the news. U.S. markets followed suit. The Dow dropped 280 points, and the S&P 500 also closed lower.
Tell us what is going on with Credit Suisse, and is there ties to what we saw happen with Silicon Valley Bank? What's your read on things?
All banks are under scrutiny right now, but Credit Suisse has its own issues. It delayed releasing its annual report because it found material issues, inaccuracies probably in 2021 and 2022. That set off some fire alarms. Shares started plunging earlier this week. Its biggest investor, the Saudi National Bank, could not invest more in the bank. It needed some capital. It couldn't because of regulatory restrictions, and there was concerns. Shares plunged 30% yesterday. They've rebounded. Why? Because Credit Suisse is taking that $54 billion loan from the Saudi National Bank, the Swiss National Bank, I should say, and that's going to stabilize it. So shares are back, and that contributed to a market recovery yesterday because, as you said, Dow was down 725 points. At the close, it was only down about 280 points. So there was a recovery there because of this, but this is one headline after the other that says there is trouble in the banking sector, and now it's spread overseas.
Well, today saw the second day of sharp falls for its shares after the Swiss bank yesterday disclosed that its auditor had identified material weaknesses in its financial reporting controls. Its biggest shareholder is the Saudi National Bank, which holds almost 10% of the Swiss bank. It now says it can't increase its stake on regulatory grounds. Our business presenter Ben Thompson looks at Credit Suisse's growing problems.
There are very specific reasons that Credit Suisse is finding itself in this position. You may remember the Greensill scandal. It was caught up in that. There were big issues over Mozambique, its investments there. It was also convicted in last year, in the summer of last year, of failing to prevent money laundering. It unveiled a big turnaround plan. It announced a $4 billion loss last year. Speculation clearly over its financial health, whether it could meet those repayments, whether it could meet those loans. And now just the latest suggestions in its delayed company report that it was reporting of material weakness in its financial controls.
Well, picking up on that material weakness is Victoria Scholar, Head of Investment at Interactive Investor.
It's 5-year credit default swaps, which is essentially a measure of the cost of insuring against buying its bonds. So it gives you a clue about how risky its bonds are, have soared to a new record high. Like you say, this week it found material weakness in its financial statements and that it's been unable to stem outflows. But the latest is that its biggest backer, the Saudi National Bank, isn't going to be providing any further financial support, and it won't be going above 10% in terms of its holdings. So the stock was actually halted after its second day of decline.
Well, confidence in the sector took another knock late on Tuesday when the ratings agency Moody's revised its outlook on the US banking system to negative from stable, citing heightened risks for the sector. A spokesperson for the US Treasury has said that it's monitoring the Credit Suisse situation. Here's what the EU's Commissioner for Finance Services told the European Parliament in Strasbourg earlier today.
We can say that the EU banking sector is in overall good shape. It has built up its resilience in recent years, and it is supervised closely by national and European authorities. But I think at this very early stage, we can start to look at some of the lessons that these failures in the US have for the European Union.
Well, let's cross over to get some analysis from Susanna Streeter, Head of Money and Markets at the Investment Services Hargreaves Lansdown. Susanna, welcome. Let's just focus in on Credit Suisse. Is there a real risk that it could go bust?
I think there is growing concern about just how robust the bank is, particularly when we hear that Swiss authorities talking to the bank's management to try and work out the way forward, and alarms have been raised by at least one other European government asking authorities in Switzerland to take action to try and restore confidence. Certainly the bank had already been experiencing problems, but what's happened right now with this banking rout and concerns about the impact of the SVB Silicon Valley bank collapse and the impact on smaller banks in the US is that investors are really sniffing out weakness and voting with their feet, exiting positions they think are too risky. And that certainly seems to be the case with Credit Suisse right now. So we'll have to really watch this space. There are plans for, if the worst scenario does emerge, a kind of orderly exit that was set up after the financial crisis, but we haven't had really a need to see this. And certainly what I would expect before we get to that point is that perhaps some kind of backstop being offered to Credit Suisse in terms of stopping further deposits leaving the bank.
And when we talk about material weaknesses that were described in the report, just help us to understand what that means in layman's terms.
Well, certainly what's happened is that the bank has said, we've gone back, we've looked at the way that we've analysed our accounts, and perhaps we haven't spotted where more risky bits of the business have been. Now, it's unclear exactly the full detail of what they're referring to there, but certainly some of their risk management left something to be desired, and that has certainly sparked fresh concerns about just what's happening at Credit Suisse. And that's why you're seeing this flight today, but also the very fact that actually one of the investors, a Saudi National Bank, who invested in the bank when it raised capital through an equity raise late last year, said it couldn't actually invest any more in the bank because of regulatory concerns. That led to worries that there wasn't any kind of easy exit from this situation Credit Suisse has found itself in. So certainly what we're hearing now is that negotiations will be taking place to try and come up with some form of reassurance to stop an exodus of deposits from the bank.
And while all that's happening, of course, we've been talking about this for a number of days now. A lot has been talked about the interest rates being hiked. Helped us to just understand the link with higher interest rates with what we're seeing now with these banks.
Well, when interest rates are hiked very, very quickly, that affects the value of bond holdings. So they drop. The value of bonds drop as a result. And what happened is that some of these banks, including Silicon Valley Bank, actually bought a lot of these bonds, hoping to get a higher return over a longer period of time. But effectively, it used the deposits that its customers had put into the bank to try and make this return. And then when interest rates have spiked, it meant that their bond holdings were worth a lot less, but it still had to sell them anyway. And that's where then we saw this exodus of deposits, this worry that actually the bank could turn insolvent, which it eventually did. And the worry is that perhaps other banks are sitting on big unrealized losses. That's not a problem if they don't have to sell them, they can hold them to term. It is a problem if they're forced to sell them because deposits are leaving. And that is why there is so much nervousness around at the moment. And the worry is that actually that could happen more, particularly for regional banks in the United States.
Credit Suisse has some serious issues, no doubt, but it's important to remember that it's not the same as Silicon Valley Bank. SVB was bankrupt because of its unrealized losses. It did not receive sufficient regulatory attention because it was not a systemically important financial institution. The bank run had already started by the time anyone noticed. The situation at Credit Suisse is very different. Many of their wealth management clients have lost faith in them as a result of recent scandals and risk management failures. However, there is still a healthy financial position, and the Swiss National Bank is providing ample liquidity and helping to investigate potential strategic moves. However, nobody can foretell the future in these unstable times. Tell me about your experience with Credit Suisse. Leave a comment and let us know what you think. Thank you for watching, and we'll see you in the next episode. If you enjoyed this video, please give it a thumbs up and think about subscribing to the channel.